Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us this afternoon as we take a look at wide range bars and gaps when trading the CME FX future contracts. Now, before we get started today, I do want to welcome the CME and thank them for their dedication to the educational process and for making today's event possible. Now, we do have a brief introduction about the products we're going to be talking about today, and I believe we have Dave Schultz is with us to briefly go over a couple of slides, and then he'll bring Tim Moores on so that we can get started. So actually, I'm going to pass the ball over to you, and I think it's Dave, if you can unmute your phone, let's get started.
Good morning, everyone. Thanks, Cynthia, very much. My name is David Schultz. I'm a director of foreign exchange at the CME Group, and likewise, what Cynthia said, we certainly enjoy the opportunity on the education front working with Interactive Broker. I would like to go over briefly before we bring Tim on. I'm sure you're very excited to get his updates on the market and his style of trading. So what I'd like to do is just go over the world market opportunity from the CME Group. Certainly we have a diverse asset classes that you can trade at the CME Group. We have foreign exchange, we have stock indices, we have agricultural commodities, and we have energy, metals, and interest rates. Today I'm excited that we're going to talk about our foreign exchange products. Certainly you have equivalent market exposure with lower capital requirements. There's no uptick rule or short selling restrictions. We have around-the-clock markets. In our foreign exchange market, we are actually open 23 hours a day. We open up at 5 p.m. Sunday evening, Central Time, and that is for the trade date of Monday, and that goes till 4 p.m. From 4 p.m. to 5 p.m., we're actually shut down, and then we reopen at 5 p.m. for the next day's trading session. We have all the financial safeguards of a regulated exchange. And in terms of our foreign exchange market, we are the world's largest regulated exchange in the world. Just to go over a few things quickly about our foreign exchange market. Last year we averaged over 120 billion in daily liquidity, and that is in all our foreign exchange. And as you can see, we offer 56 futures and 31 options based on 20 currencies. The level playing field is very, very important to note when you trade our products. You see you have the same tradable prices as a bank, a hedge fund, a retail trader, and you have complete anonymity with all bids and offers. But I think one thing to note that's very important when you trade on our platform, it does not matter, or our Globex. One thing that is very important, if you are a one-lot trader or a 500-lot trader, we have a first-in, first-out method of trading. So if you are the first in other words, if you would put your price in first on the bid, you would be the first one executed. You have the same advantage as any bank or anyone in the world when you trade our products. And you can also work the bid, you can work the offer, and what's always great is you can improve the bid or improve the offer. So it makes trading very, very fair and, as we say, a level playing field. Of course, we have electronic access around the world and around the clock, and that I stated the 23 hours of trading, the safety and security of the CME, the unparalleled backing of the CME clearing, virtually mitigates counterparty and credit risk. The most important thing I think you have to remember, certainly when you look at the major places where you can trade foreign exchange, we are the second largest in the world for trading foreign exchange today. And that's very important, because what really brings the best possible markets that you can trade is we have access to all these global participants, including the banks. We have hedge funds, we have proprietary trading firms, and we have active individual traders. And with that, all trading in one area, you certainly have the liquidity, transparency, and in the major currencies, you're always going to have tight bid-ask spreads. What I'd like you to, and again, if you look at the bottom, we have our website, our CMEgroup.com FX, if you actually go to that page on our website, I think you're going to find valuable information, whether it's taking courses with the CME. But one thing I think you're going to find very useful, and that's on the right, and that's the I'll put my arrow on. It's very small, so we won't go over it, but it's our CME equivalence price. And what this does is this actually takes our foreign exchange product. They are actual live prices. You can view our prices. The first thing that's going to come up when you look at it, if you notice there's three fields, it'll go euro, yen, and British pound. There's actually a drop down, say by the euro FX on the top one. And one of the things to note is you can drop down and you can view all our currencies. Certainly when you are trading, you're looking probably for the most liquid products. And what I'd like to do is actually just give you a brief update of the type of volume and the notional amounts that trade in these currencies that you should be looking at. Like in our Euro FX product, we trade, I'm looking at just 2 days ago our volume. In the notional value, we did about 63 billion just in our euro, and that puts us well over 300,000 contracts. And normally you can look in that market and it's one or two prices, and we have continuous pricing, like I said, for 23 hours. The other ones you should look at, it's interesting that the rankings used to go euro, Japanese yen, British pound, but we actually have seen a real uptick in other markets. So the rankings would be, the top one, of course, is your euro contract. And there certainly is quite a bit of news about the Eurozone going on today, and so you're seeing quite a bit of activity. The one to really keep your eye on is this Australian dollar futures. We're currently doing about over 12 billion a day, and with the Australian dollar and the Canadian dollar market, in terms of commodity currencies, in terms of their overall, the way they came out of after 2008, the credit crisis, certainly there's been so much renewed interest in trading those products. But so they would go euro, Australian dollar, Japanese yen, British pound, Canadian dollar, Swiss franc, and even Mexican peso you could take a look at. We're actually doing about 1.3 billion a day, and in contract terms that would give you around 25,000. So it's something else to take a look at. And before I finish today, I'd just like to mention that we also have e-micros on 9 of our pairs of our currencies. And again, you can take a look at all the different pairs they are on the website. But they are 1/10 the size. So if our euro dollar contract, the contract size is 125,000 euros. And that tick value, if you would buy one and sell one, and you made 1 point, would be $12.50. If you traded our e-micro contract, it's 1/10 the size, for 12,500 euros, and actually, so the tick value would be just $1.25 to trade that. Again, we're seeing quite a bit of activity and renewed interest. We have some market makers in there. It's a great starting point that can transition you into our standard size contract, or it may be the perfect size contract for you to trade. So with that, it was a brief overview. I know you're very excited to listen to Tim today. I'd like to turn this over to Tim. I've known Tim, if any of you are repeating our last presentation, Tim and I have known each other quite a long time, and he's a very knowledgeable person. And there's certainly so many different ways of viewing the market in terms of charting techniques and understanding and getting a roadmap and educating yourself for the day of trading that day. And so it's very exciting to have Tim Morge. He was a trader, one of the larger traders in the world that traded on the exchange floor and at a bank, and I certainly think you're going to learn a lot from him today. And it's exciting for us to work with Tim and Interactive Broker, and I'd like to turn the presentation over to Tim at this point. Thank you very much.
Thank you so much, Dave. Hopefully everybody can hear me. Yeah, we good? I've known Dave, it seems like forever, and it's always a pleasure. Of course, I love Barbara. Always a pleasure when I get a chance, even if it's briefly, to interact with you. Dave and I go from the beginning of time. I still have a seat. I've had my seat. At that time, in order to trade currencies, you had to have an IMM seat since 1980, and I still have 3. I proudly have 3 coats. 2 of them are worn out, and 2 of them are on the wall hanging. My children both have coats. I am a CME guy through and through, so nothing excites me more than the Chicago Mercantile Exchange. Let me point out a couple quick things. First of all, normally we have unlimited time, and Cynthia is nice enough to hang around and let me go 2 or 3 hours because, as most of you that have been around know, I will talk forever if you let me. But we do have a limit today, so you should be seeing a picture of me at advanced use to wide range bars and gaps, yes. Cynthia will let me go forever, but today we have a limited amount of time, so I will take questions at the end. We'll have plenty of time for questions, and it'll be a good presentation, but I can't go 2 or 3 hours. I wanted to point out a couple quick things that I love about the CME, just because Dave mentioned them, and I want to give him a little more. One, first of all, I use the CME equivalence page all the time. If I want to chart cash, and I'm looking at the cash market on a chart, and I want to figure out, hey, I wonder what the CME price is. Let me see where they are compared to what the cash guys are making me. CME equivalence gives me the price immediately. So I keep it up on one of my screens all the time. I use it all the time. So do yourself a favor, figure out where that page is. It's easy to find. Put it up. You can see the bids and offers. You can see what the cost to carry is. It's a great tool, and it's been around for a long time. And I highlight sometimes much more in some other presentations, and I need to do that in micros as well. But that's a good one. Second of all, I'm just going to give you a hint. Later on this spring, I'm going to be a little more involved. I'm going to be doing something with, just use 2 words, CME Futures University. That's all I'm going to say. And I'll leave the rest of that to Barbara for later. Last, Dave was talking about Canada futures and Aussie dollar futures. They rock, boys and girls. If you're not looking at the Canada futures and Aussie futures because you're stuck trading, and there's nothing wrong with the EuroFX futures or the Swiss futures or the yen futures, but man, they rock. When we do our live sessions in market geometry, we're hard pressed not to be talking about Aussie or Canada all the time because they just rock and roll. There's not as much noise as there is in the EuroFX, not as much pushing and shoving like the E-mini S&Ps, and in the last couple of years, well, really since 2008, they just blossomed, and the volume is there for everybody. I don't care what size you're trading. You can put it through. So definitely take a look at those. Today we're going to look at the euro, unfortunately. But that being said, please take a look at those. Last thing, we're going to do something different today, and I did it a little bit. It could use some improvement. It's the first time I've done it here with Cynthia, and Cynthia and I will work it out for the next one. But I included my notes because at the end you'll be able to download this PDF. And I lecture over 12,000 fifth graders on a regular basis using virtual technology, actually WebEx, and like we're using today. And I also teach at Stanford, MIT, and the University of Chicago private classes. And when I do, of course, I always have notes in between my slides because just passing out slides, you can look at a chart, but if there's no notes, sometimes you scratch your head and say, I don't know, do I want to go back to the middle of the? Not that I don't want you to watch this presentation over and over, but let's say you're trying to just hammer home one of the charts. You can go to the next page and just take a look at. It's not exactly what I say, but it'll just give you a brief description of what was on that chart. So we've included that, and probably for next time what we'll do is we'll include it in the handout, but not put it up on the screen if we can. Cynthia and I can work that out, but we did that at the last moment, and it's my fault for not doing a little better. Then last, I gave you some homework, boys and girls. There's 5 or 6 charts afterwards, and these 5 or 6 charts at the end are a dialogue back and forth between myself and my partner Shane Blankenship, and we do the live sessions at marketgeometry.com. And if you take a look at it, it'll be from this first trade all the way through today's trade, all the way until last week, and you should be able to recreate these and take a look and see exactly what we're talking about and see how this type of pattern, as well as a different use of wide range bars evolve day after day after day. There are so many entries, so many possibilities. If I had actually tried to do a webcast with those and done everything on those 5 charts, we'd be here for 5-6 hours. So that's your homework. Go ahead and take a look at those afterwards when you download. So with that, let me take a drink of green tea and we'll get started. Okay. You know who I am? Market Geometry, that's my webpage. Anytime we talk about financials, we need to do a brief disclosure. Cynthia's already showed hers. The key here, really, you can go ahead and read it, but I'll just give you, let me just break it down quickly. There's no Holy Grail. It doesn't exist. If you came here to get the Holy Grail, I don't have it. It does not exist. Stop looking for it. The closest thing I can give you is hard work and quality education. Cynthia and IB give you and the CME group. They all give you great opportunities for quality education. The hard work, you'll have to bring to the table yourself. The other thing I would highlight is, let me get my little pointer, there we go. Other thing I'd highlight is right here. This is one person's experience. Your experience may differ. Look, my ability in the markets is different than yours. The way I look at the market is different than the way you look at the market. But that being said, it doesn't mean that you cannot take a look at this. We call it observe, validate, and then draw conclusions. You can take a look at what I do. Don't just do what I do, but go ahead and validate it. Make sure after some observations that you think I actually know what I'm talking about, or maybe I'm full of it, as they say. But your experience may differ. Please don't do anything blind. I don't care who tells you is going to work, including me. All right? But I hope you walk away today. You should be able to walk away today with some techniques that you can put right into your trading. But validate them first, please. All right, let's move on. So I want to dedicate this this webcast, and for this whole year, I'm highlighting Dr. Alan Andrews, my first mentor, a great market researcher. He first applied Newtonian physics in the 1920s to develop the median line, or you guys mostly call them the pitchforks. It's one of the only true leading indicators that are available to traders anywhere. If you want to learn more about it, go to Market Geometry. There's tons of free stuff. Before you spend $1, go through the free stuff, please. And secondly, I was lucky enough as a teen that cranky Amos Hostetter, he's almost as cranky as me, I'm now the cranky man, at that point, and he died unfortunately in a terrible accident. But that being said, I had 4 or 5 years with him. I think he was probably the best money management specialist in the world and the best campaign trader. I've studied charts that are over 300 years old, and I've never seen anybody able to campaign trade better than him. I've cornered or been involved in agencies that have cornered 4 markets, a couple of them with Amos, and I've never seen a portfolio trader anywhere near as good as Amos. If those of you wonder where he came from, he was one of the partners, one of the 2 partners that started Commodities Corporation. They brought him in early on when things were a little bit bumpy, and as soon as he came in and introduced risk reward and money management, things settled right down. So I give my props to these 2 gentlemen for the entire year. Everybody should know where they came from, and they should acknowledge it. So today we're gonna look at the advanced use of wide range bars and gaps when trading CME Group currency futures. There's 2 lessons here. One is what I just said, and 2, most traders have a problem with this. They're afraid to let their position go when the market's running because they think they'll never have a chance to get back in. Now, when we look at, let me just go to the next chart. Here's Mickey saying, hey, mysterious secret math. And we're going to use Mickey the alchemist. Mickey represents Sir Isaac Newton, who was an alchemist if you didn't know it. But we always use the picture of Mickey because the ones of Sir Isaac Newton are not this nice looking. Let's start out where we ended last month's presentation. And this is the chart at the end of last month's presentation. And what we did last month is we took a look and we built everything off of this gap right here. And according to Dr. Andrews, and he locked a bunch of graduate students in a room in the mid-1920s with pencils and yellow notepads and made them do homework. And one of the things they found out was they developed action-reaction lines and median lines. But another fascinating thing they found out was that if you take a look at gaps, and during last month's presentation we showed you that gaps are the same in 24-hour markets as wide range bars in certain circumstances. They have a high and a low pivot that are extremely important, and you can use them as a high or a low pivot. Now, you can't use them in the middle of noise, But this is an extremely important pivot area right here. And we used this, and you can go back and look at last month's presentation, and we explained exactly how we used it. Then we just used a simple median line from this high to this low to this high. And then one of my favorite entries, a test, and then a retest, that second bar. And I entered on that second bar. Then you can see me move my stops lower. And I had my profit target down at the median line. I had my hands out. Hey, if it gets to the median line, Andrews 101 says that prices, if they're headed toward the median line, will make it 80% of the time. That's been proven over and over and over statistically. I had my hands out. I got filled at the median line. And you can see I risked 30 ticks on this trade and netted 167 ticks. My actual risk reward that I put in the pocket was 5.5 to 1. I never traded less than 3.0 to 1 to start with. I know some of you are going to say that's backward. It's 1 to 3. That's fine. But this is how professional traders talk. I'm not going to try and turn the tide, so to speak, change the trend. But again, price makes the median line 80% of the time. Give me my money. I'm more than glad to get out. Now, take a look. Price comes out of the hole. I've already got my money. I've got my 167 ticks. And the reason why this is important is because if I don't care if it goes up or down. At this point, I've got 167 ticks. My maximum stop on a 20-minute Euro FX futures contract is 30 ticks. So I've now rolled forward 5.5 stops. Okay, so that means I can lose 5 times in a row if I get filled at 30 ticks or less, and I'll still be trading with the market's money. This is a traditional median line. I take my money, I run. Now, take a look. We get a gap open. And here's what people are afraid of. Uh-oh, it gapped lower. I took my profit. This thing is going to go to 0. I only got 167 ticks. I'll never get back in. It's just not so. Yeah, will you miss some trades? Absolutely. Will there be times when the bus leaves without you? Sure. Will there be times when it backs up and you'll get profit stopped out here? Sure, but that's not the end of the world either. I mean, at some point you do have to protect your profits. So, as we take a look at this, in the back of my mind, I'm thinking 2 things. One, I got my 5.5 stops rolled forward, or 167 ticks, and I think in terms of units. So I've got 5.5 units in the bank. Now, my mind is clear. My mind is free. I can go out and get some green tea, walk around, take the wife to lunch, whatever, depending on what time of day it is. I don't have to trade. If I don't see anything I don't find interesting, I don't have to trade. Let's take a look. Where are we? We gap lower. Do I want to just sell at the market? Well, my stop has to be all the way up here. Am I sure this is over? Hasn't taken out this low. Hasn't taken out the median line. I have a major swing low down here. I'm not sure I'm ready to just jump in. I don't have to, because I've got 167 ticks in the market, right? So, what's a trader to do? So here we are, just dead blank, empty chart. This is how I always start the morning, unless I have an open position going. If I have an open position going, that's one thing. We've got the empty chart. Price gap's lower again, telling us there's a high probability that there are significant sell orders, probably up in this area, above the market, and that the market makers are leaning on these sell orders. Okay? Those of you that don't know, there's a rule now called the Volcker Rule, and the Volcker Rule says that, banks and lending institutions and really almost everybody other than speculative people like me have to turn their positions quite quickly. That doesn't mean, if they have orders though, that doesn't mean they can't front run orders or get ready for orders. In other words, if they are selling, they have orders to sell up here, they can sell in this area for a quick in and out, but they can't hold large positions for long periods. Remember, foreign exchange used to be the wild, wild west. It was unregulated. Those days are going away. These orders are left by whales, the largest position or portfolio traders in these markets. Dave mentioned that I was very large at one point, and he didn't mean by weight. I'm still one of the largest traders in most of these markets, and people do lean against my orders. That's okay with me. I don't mind. Now, you don't have to be a whale to take advantage of that. In fact, all you have to do is learn how to read the tracks, which is what we're going to try and teach you a little bit today, and what we try and teach at Market Geometry all the time. Again, I see people asking questions. If I took the time to read questions and answer them, we won't get anywhere. Just relax and go with the flow. You can always email me afterwards. And you'll see me just pass through the verbiage, and as I said, we'll clean that up for the next presentation. So you'll just see the charts, but you'll get the verbiage next time. So I'm currently flat as I view this chart, and the gap lower on the opening makes me interested in finding a nice area to get short. Now, how do I find a nice short in a market that's already fallen so far? Look, we've gone really vertical. We didn't take out this low, but we've really gone vertical. It's gone so fast, and now it's gap lower on the opening. A lot of people feel, oh, I've got to trade. If I don't trade, I'm going to miss this whole thing. It's going to go to zero, or I've been sitting on the screen for 2 hours and I don't have a position, et cetera, et cetera, et cetera. After a vertical fall, this is what we found. Price often has to eat up time or space before moving on with the trend. Now, these days, I like to use the term space because many of you are using bars that are not based on time. You're using tick-based bars, range-based bars, point and figure formations, market profile formations, et cetera, et cetera. I mean, I can go on and on and on. So let me show you what I mean by eating up some space. So there's the verbiage. We'll get into a rhythm here at some point. This is what we call the line of force. And you can see price falls vertically. We found that when price falls vertically, it's not sustainable. It doesn't mean it can't fall vertically to here. You never know exactly when it's going to stop, but when it does stop, it generally has a pullback. So we look for logical profit targets. Then what happens after price makes a vertical fall is it eats up some time and space, time or space, however you want to talk. Most people are more comfortable with time. I like to use the word space. Now, maybe this is hard for you to see. So let me do a trick that I used last time. I'm going to take the price bars off of the chart, and maybe it'll be easier for you to see the market breathe. We call this the language of price. Take a look at the chart. Price falls vertically. Price needs time to eat some time or space. Now there's a more sustainable set of swings with higher highs and higher lows. Price is still moving up, but if you take a look at it, it's really congesting or trading in an energy coil, restoring its energy. Then it falls vertically. Now, this is exactly where we are right now. We have the gap open lower. Is it time to eat some time or space? Is it time for price to eat some time or space? Or do I want to just sell right here on the opening and go for it? That's what a lot of traders, boy, you know what, I got a gap lower, I'm going for it. Once we enter, oh, there we go, sorry. Here's the new chart. I will get in the rhythm, I promise. Maybe I should ask Mickey the Alchemist where to sell, right? Let's look at a more simple way and see if that helps us find an area to stock a potential short position with good money management. Take a look. Major gap lower. I can draw what I call a multi-pivot line. New gap should mean new sellers. Should I sell here on the opening? Shall I sell the closing of the bar? Should I anticipate the closing of the gap? All those are possibilities. All those are things you should be thinking about. Maybe you want to ask, if you have Mickey at home, maybe you want to ask Mickey. There's Mickey for you. Now that didn't make it much clearer for me. Maybe there's some other tools to help us look for a good area to get short in this market. Let me take another drink. Here's a real easy one. No offense to anyone, my partner uses it all the time. I call it a Dumbo line. And by Dumbo, I mean anybody can draw this. All I do is connect a bunch of highs. Can everybody see that? Very simple. How many people have done that? I'm not going to count, but I'm sure somebody has. You know what? Just be honest. Nobody else can read you anyway. So I just connected some multiple highs. What do we call that? A change in behavior line. If price takes that out, here's our gap lower. Here's where we currently are. If price is able to bust above there, well, maybe my whole idea about being short is not a good thing. Maybe, maybe not. Take a look at it. Let's look at another idea. Here's another. I would call it a Dumbo line. It's a little more intricate. Bottom of the gap. What's Dr. Andrews say? This is a low pivot. This is a high pivot. Some people would say that this is the top of the gap. Okay, fine. I'm not going to argue with you. In fact, my partner Shane and I have different opinions about whether this is the low and this is the low, whether this is the high or this is the high or this is the high, whatever. It doesn't matter. The point is there's some unfilled space here. I know it was filled later on, but that's not what we're talking about. But here's the key right here. Bottom of the gap, and then we run through a bunch of highs and lows in this area, and we draw a simple horizontal trend line. Dr. Andrews would call it a multi-pivot line. Now take a look at this. I've got the gap where we are right now. I've got the change in behavior line. I've got the bottom of the gap multi-pivot line. Kind of in the same basic area. How about another idea? This one's a little more tricky. So we've gone from easy Dumbo lines to something that has a little bit more art in it. I can draw on the center line of an action-reaction set that starts from the highest high after the first gap. And by the way, I have no idea who Paul Andrews is, and I spent 17 years with Dr. Andrews. So let's just leave that stuff out, guys, and pay attention to the presentation instead of advertising for somebody else. I can draw on the center line of an action-reaction set that starts from the highest high after the first gap, cuts down through for the price action. See how it cuts through here nicely? Charts, we're visual. Humans are visual. They should be pleasing. If they're not pleasing, they're not doing their business. Okay? So it grabs the tops here. It cuts through the center action. And it grabs the same tops that we were looking at when we were looking at the change in behavior line or the Dumbo line. And also, I really like this. Price comes down, hits the line, bounces up, zooms through it, retests it from below. We call it a switchback. This is Dr. Andrews' lingo. When price comes and zooms through, it's likely to retest. And sure enough, you can see it retest here and fail, retest here and fail. And look at the retest as it crawls along this line. Now we get a gap lower. So we have that going for us. Now, the thing about center lines is, and this is the first thing Andrews developed, was center line and then an action-reaction line. They look like pitchforks, but they were derived directly off the center line. Later on, he developed the median line, which has a mathematical probability attached to the pivots, so you feel more comfortable because it has a mathematical probability. But center lines take some practice. I used to say it takes 10,000, draw 10,000 median lines, you'll begin to see them. Center lines, draw 100,000 center lines, 200,000. Because there's art, and my center line may not be your center line. I can draw 3 or 4 or 5 that work really well here. Depends on what I'm trying to do. There are ways to check it that's a little more advanced. We're not going to get into that today. But You can see why I chose this. Go back and take a look at it yourself. These we call press lines. Take a look. You can see the highs being pressed down. Here you can see the buyers coming back. Here's another set of lines where people are pressing. And it measures what the interest is at the market at that point. And you can see it switch off from sellers to buyers to sellers again. And then it's our center line right here. All right, so what are we going to do with this? Well, I'm still kind of scratching my head. Still kind of scratching my head. So let me give you another possibility. Now this is a traditional median line drawn from the bottom of the major gap right here, pivot A. It's the recent major, and then from the recent major high here at B. Nothing sexy here, so to speak, other than we're using the gap. A lot of people would go all the way over here to the A. They might cheat and go over to this low. They might even use this low. I'm using the actual gap. Andrew's pivot. A, most recent high B, most recent low C. A, B, C. Now, if we take a look, we've gapped lower through it. Okay? So, as I take a look at this, as all of you take a look, what do we have? Do we have a median line that's done much for us? I take a look at it and I say, well, it doesn't really look like it's describing price very well. It hasn't tested much. Do I have another tool that gives me the same mathematical probability? Because this median line has a mathematical probability. Yes, I do. Price has fallen vertically. When price falls vertically, especially in the currencies, I have found that if you use a modified shift, and this is what it looks like, all I did was move the A point up 50% and over 50% and leave the B, C the same. And you can see that this, I'll go back, upsloping traditional median line becomes a downsloping modified shift median line. It still has the same mathematical probabilities. With 80% probability, price should make it to the median line. If it fails at the median line, it should make the lower parallel. If it zooms through the median line, it should make the upper parallel. But I have mathematics and statistics to go along with this particular set of lines, which I didn't with everything else I showed you. No matter what you read in other people's books, all those other lines that are drawn are just about noise. This is an 80% probability. Now it's fascinating. You could have drawn off of this low and this high and this low and gotten to the same thing, but almost no one would have. You could have also extended it up to this high, but then you'd be drawing high, high, low. And when you do that, you lose the mathematical probability. So again, we always need a low, and I use the low of the gap, a high, and a low, and then I use the modified shift, which moves it over 50% toward the BC line and up 50%. All right. Now once again, median lines have a mathematical probability built in. Price will reach the median line or its parallel 80% of the time. This concept has been proven time and again statistically since the idea was first pioneered by Dr. Andrews at MIT in the mid-1920s. As I build this market map, okay, as I build this market map, I'm looking for a pendulum pullback to sell. So I'm expecting price to test the median line before it turns lower to head to the lower parallel. What does median line theory tell us about what price will do when it tests the median line? About half the time it stops and reverses. The rest of the time it accelerates. But remember, we are Newtonian chartists, and we believe when price is in a trend, it tends to stay in a trend. Let's see if we can put all the clues together as we build this market map. Let's overlay them all and take a look and see what we got. So here's everything all together. I've got my Dumbo line here. It's in red. I'm just connecting the tops. I've got my multi-pivot line that comes off the bottom of the gap. I've got my action-reaction line from the highest high prior to the gap that we used for the first trade. Gives me a beautiful cut all the way through. I've got a modified shift median line that has a probability attached to it that says price will reach the median line 80% of the time. Now take a look. I've got an area where everything all comes together. So this is a very interesting area for me. And this makes me sit up in my chair. The first thing that makes me sit up is the gap lower. But I'm not ready to trade yet. What do I want to see? I want to see what I would call a pendulum pullback. Price comes to its extreme, then it pulls back. And then if I'm correct and it heads lower, it makes it extreme, then it'll pull back. So I'm always looking, if I think things are in a downtrend, I'm always looking for the next pullback to sell. If I think things are in an uptrend, I'm looking for the next pullback to buy. Here, I'm looking for the next pullback to sell. And this is the area, if it's going to pull back, this is the area that it should run into trouble, right there. Now, here's the question. I identified an area, big deal. If I can't afford it, it's meaningless. One thing Amos taught me was, just because you want to get short, just because you think something's going down, if the numbers don't work, if the statistics don't work, if the risk reward, and that's the key, the risk reward, and the size of your stop don't fit your risk profile, there is no trade. You can't cheap it out. If you cheap it out, you're likely to just get slapped. You might as well just write the check, take it out of your IB account. You're going to get caught. You want to place your orders above where it's likely you're going to have protection from the whales, all right? So I don't expect too much of a pullback, both in price and space or time, because of the area of confluence I just diagrammed out right in here. So here are the orders I place in the market. And let's see if they work. I place a limit sell order at 129.45. If it gets anywhere in this area, I want to get short. It's right about in the middle of the ellipse I had before. I could go a little bit higher, but I don't want to miss this if it heads lower. Can I afford it? I place an initial stop loss order at 129.65 above these highs. I'd love to be above these, but what's the deciding part of that equation? If I'm filled on my limit sell order, where would I take profit? I'm going to go with Dr. Andrews. 80% of the time, if price is coming off of the median line, it's likely headed to the lower parallel. Now, there are other ways to set up logical profit targets, but let's just go with the simple one. I'm going to run into trouble two places. At the lower parallel, where mathematics tells me price is likely to run out of downside directional energy, or this prior low. And if I run the cursor over, I'm about in the same territory. So this is the first area, if we're able to take out C, where I'm likely to run into trouble. Let's see if the trade makes sense that way. So if I'm filled on my limit sell order, I'll place the limit buy order at 128.75. This means I'll be willing to risk 20 ticks to make 70 ticks, a risk reward of 3.5 to 1. Again, I would love to have placed my initial stop loss order at 129.75 up here above these. Okay? But risking 30 ticks on this trade is too much. The risk reward does not justify that much risk if I use a realistic profit ticket target. 70 divided by 30, you get it, it's well under 3. So I'm unwilling to take that trade. But I am willing to take 3.5 to 1, which is a 20 tick stop. And that's over. Look, we made this low. Is it a swing high? Officially, no, but it's going to be if I'm right. If I'm wrong, I'm going to get stopped out, and it's going to become just a blip on the road. But at the moment, I call it a pseudo swing high, but I know that there are orders. I don't know. I assume there are orders from whales like me right in this, anywhere in this area, from 129.60 up to around 129.80. There's going to be orders to sell, and I'm going to lean against these orders. And hopefully, if price gets up there and I get filled, it'll slow price down and keep me from getting stopped out. Sometimes you get stopped out. Stops are your friends. It's the nature of the market. Don't be afraid of getting stopped out. So let's take a look. Price pulls back higher in a classic pendulum pullback. See it? We get about 8 bars, and then we get a nice run higher, and it runs through the change in behavior or Dumbo line bar. It runs through the action reaction bar. These are right at about 129.40. It runs through the multi-pivot line, which is another area. And lo and behold, take a look where it stops. It stops right at the median line. Price runs out of upside directional energy exactly where it is supposed to, at the downsloping median line. And it stops to the tick at the median line. You see this so often. That same bar becomes a wide range bar lower. In our charts, we mark it on WRB. You'll see that in the last 5 charts when you get the handout. That closes on its low. So price worked its way higher. I call this opening the door. If you think of this sloped line as a door, market participants opened the door. They ran in. They saw lions and tigers and bears, and they got chased right down the hallway. And this bar closed all the way down here. That's a beautiful bar if you're selling. So I'm filled. I'm filled all the way down here. I was not cheap enough. I could have cheapened it out. I could have went right for the. If I'd gone for the median line, I probably wouldn't have got filled. Or maybe I did. If I was first in, as Dave said, maybe I got filled. But if I was a 10th guy, probably not going to happen. But I certainly could have maybe gone to 50. But I wanted to make sure I got it. And I was aggressive on this 50, no doubt about it. But not as aggressive as selling down here on the opening after the gap lower. I'd be stopped out if I was just risking 20 or 30 ticks. So I was patient. I found an area. Now the question is price going to work its way lower, or am I just going to, it hasn't done anything yet. Hasn't taken out the C pivot, hasn't taken out the prior low, hasn't made it to the median line. But I mark, people ask me all the time, how do you get that price at the median line? Take a look. I looked at how long it took to run up, and I just went over 5 or 6 or 7 bars and ran a vertical line. Went down to the lower parallel, ran it over the price and said, hey, 128.75-ish. Okay, I'll just put my initial profit target right there. That gives price enough space to work its way lower. You have to put your order in somewhere. So I give it 5 or 6 or 7 bars. Then as price starts to unfold, you can always adjust that profit target as you see the rate of movement, so to speak. Let's see what we get. Well, the good news, I'm out. I got in and out very quickly. So remember, you never know what the markets are going to do. I was in and out of this trade nearly before I knew what happened. Price moved down so fast, I never had a chance to collapse my risk. In other words, go from risking 20 ticks to maybe going to break even, or maybe if I was nervous, maybe, and we were making new lows, I might hide under the high of this wide range bar. I didn't get a chance to do anything. I didn't even get a chance to take a look at how fast price was falling and decide whether or not I wanted to move my profit order up to maybe 125, 128, 80 or 85 to be at the median line. Price just hit me immediately. Wide range bar lower, even wider range bar lower. So I made my 70 ticks in this market, and don't get me wrong, I'm not complaining. But when trades play out in this unusual fashion, it always reminds me to check and double check the risk I put on each and every trade. I'm not a pessimist. I'm not a glass is half empty kind of guy. But my mind always wonders what would have happened if I had the opposite position on and the market traded that fast against me. So it reminds me to always use stops. Imagine if you hadn't put your stop loss order in and this thing ran the other way that fast. You would be trying to mouse out of this trade so fast you'd never catch it. Because remember, this bar closed on its low and then ran. So if you didn't have an order in the market, you'd be chasing. And you might, let's say you were trying to buy here, you might be filled all the way down here. So always place your stop loss order at the same time. I put them in on the blotter and then make them active at the same time. I don't want risk that I don't want. I'm willing to eat 20 pips, 20 ticks. That's it. I don't want to get a fill 45 ticks away. If there's slippage here, it might be a tick or two. I'm fine with that. But I don't want to have to make a decision 25 ticks higher because I forgot to put my stop in. So always put your stop in. And I can bracket my orders. When this one's filled, place a limit buy order, which is what I do, and make it one cancels the other with my stop loss order. So it automatically happens. But then I need to immediately go and check. Am I working any orders? Did I buy and sell an equal amount? I have a calculator on my screen. Do the P&L look correct? You want to find out now while the market's still relatively close to where you're trading. You don't want to find out in the morning, pull up your statement and say, what, I'm still short 2 contracts? And it's 4 handles different? Whether it makes money or lose money, you don't want to be in that position. So pay attention to detail. It's too hard to make money. This one, as I said, happened so fast. If you didn't have orders in, you might have been scrambling. So hard work and preparation is everything when trading these markets, when trading any markets. Do your homework, plan your trade, and do your best to execute your plan flawlessly. Now, for those of you that are curious, let's see where this market headed as it unfolded further. This is called a warning line. And what we do is we measure the difference between the median line and the lower parallel or upper parallel, and you can see it's equidistant. And Andrew's always traded with 4 on the bottom and 4 on the top. Now remember, he was hand charting and using end of day data, but he found that these lines carry the same frequency as the lower parallel or the median line or the upper parallel or the other warning lines. And you can see price zoom through, and what does he say? When price zooms through, it should retest, and it does a number of times. Now it's traded, and with 80% probability, it should hit the lower parallel. What's it do? Comes down, well, in this case, the first warning line. Comes down to the first warning line, hits it perfectly, works its way along it. So you can use this first warning line, and the second warning line, and the third warning line. Although, if you're intraday trading, at this point, you can generally find, if you can't, go ahead and use them. But you can generally find a new median line that's describing price as well or better. In this case, this median line is still certainly completely valid. Let me see. Now, I'm going to flash the question page, but hang on one second. Take a look at this. Well, that's a blank page, just to remind me. There we go. Hey, Cynthia, thank you for leaving that blank page in. These are just notes back and forth from Shane and I to each other. This is me taking profit. Okay. And here's some ideas that I want you to follow up. This is your homework, boys and girls. You saw my entry. Actually, Shane's entry is about the same. But this is the type of entry that Shane loves. He lives and dies for these types of entries. You can see we marked out the wide range bar. He put in a sliding parallel. I called it a change behavior. Same basic concept. Gap support, this is my multi-pivot line. We call this a T formation, the actual official, because of the AFTA. We now call this the Texas T, by the way. It's in our glossary. And then we look and see how price, this is a failure. This low should cause significant selling, and of course it failed for the time being, but you can see we come right back into the, I have a gap on my chart, Shane's using slightly different open and closes, but we come right back into this area, the gap, the prior gap support, bottom of the T, we're right in what we call this the gap rip zone. We come up in here, this is the sell zone for him, and he's in business right before price really takes off to the downside. And here, let me point this out. Failures always make for the big profitable trades. If you go back, if you're a consistently profitable trader and go back and do your statistics, and most of you don't, but you should, you'll find that failures at prior tested median lines or prior tested trend lines or whatever you trade off of, those failures, things that should have happened, where a lot of traders are set up for something that should happen, those are generally the big profitable trades. So if you can catch one, try and hold on. I'll flash you real quick. Let's see. Now you can see the market start to turn. And I'm not going to work through all of it because this is your homework. I want you to follow through and take a look at this market and see if you can understand. There's plenty of work in the prior sets of slides this week, this month, and last month for you to understand exactly what we're marking out here and what the structure means and what we would then draw to get you all the way to current. Now there's no description here because it's homework. Try and recreate the slides yourself. Try and do the homework. Let me flash one more. And you can see price comes down here. We've got the exact same setup. One of our students calls this the pull in the parachute ripcord. Whatever. But comes right down, time and space. Price, time, and space all meet right here at a sliding parallel, at the median line, at the lower parallel. You should be ready to trade. When you see the opportunity, you can see it bust through and fail, comes back up. You've got support. You've got a stop. Should be all over this trade. I'll leave it at that. You can do the homework, but you get the idea. There's three more. So there's your homework. I hope it was interesting. Do we have any questions?
Well, Tim,
Cynthia, do you want to do a poll first?
I certainly do. And while everyone, Tim is gracious enough to take your questions, but I do have a quick request right now is actually, you'll notice I'm opening up a polling panel on your screen. There are 3 short questions there that IB's management requires that I run get your feedback to make sure that these presentations are indeed meeting your expectations. So if you would please make your suggestion or make your selections and then click that submit button. It actually, I do review this with management on a weekly basis. So your help is terrific for making sure that we have continued events with Tim. Now also, I do want to, those of you who have finished the poll, you can simply use that minus icon on the right-hand side of the title bar to collapse that polling panel out of your way. Now, if the chat panel collapses as well, by the way, poll did end, you can all collapse it, and if you see that chat panel icon, simply double-click it and send any questions that you might have for Tim at this time. So thanks everyone for your help with that. Back to you, Tim.
Thanks, Cynthia. And by the way, anytime you do any correspondence, or when you fill out that next time where it says type your answer here, don't type my name, type in webinar, or type in Cynthia, because it gives her all kinds of kudos with people upstairs, and that allows her the ability to pick and choose quality educators. It doesn't have to be me. If you don't like me, give me bad grades. That's fine. I have no problem with that. However, if you say Cynthia or webinar, it gives her all the power in the world. All right?
Well, thank you so much, Tim. But we certainly do appreciate you. But looks like you've got some questions that are coming in, and I also want to mention that Tim is going to be back with us on a monthly basis. Simply mark that your calendar, the second Thursday of every month. Look for a webinar from Tim, and we'll be posting it and sending it out with our email blast. So do want to mention that. The next one is coming up on March 8th. So when Tim said there's homework, actually make sure you get that homework and join us again on the 8th. Okay, now back over to you, Tim.
All right, good. I had a couple people that asked questions that want them answered privately. You can email me, and or Cynthia can pass them on if you can't find my email. My email is simply, let me just cite, if I can, timothyMorge@marketgeometry.com. You can always email us, okay? Or you can just send them to Cynthia. Cynthia will forward them, whatever. Doesn't matter. Then, however you get there, that's all we want. So let me back up and see, because I have a ton here.
Well, while you're looking at it, Tim, I do see there's a question about the Futures, School of Futures, and we actually do have, I've been working with Barbara Schmidt-Bailey at the CME to bring a program on for those people who are not familiar with future contracts. Now, the first half of the year, we're actually going through very basic information if you want to learn more about trading futures. But the second half of the year, we'll actually be going into several of the different product suites that the CME has available. And sounds to me like Barbara secured Tim for one of those events. So we'll have more information. You can check it out on our site. It's not there just yet, but we will be filling in, and simply go to the Interactive Brokers webpage. There's an education menu where you can find the webinars link. So definitely check that out. And if somebody has joined today and would like to see the first event that we did back in January, it's also listed with our recorded webinars. All right, Tim, a little bit of a commercial to let you read, but I'll let you get to those questions.
I'm all good with that. Listen, Cynthia presents the best educational material of anybody. That's why I'm willing to come here at least once a month and soon more. Anyway, I'm here. I'm not affiliated with IB in any way other than I love Cynthia. I love the material she puts out. She puts out not only me, but a lot of great panelists, but great educational material. You don't see her trying to sell any IB products. You don't see me trying to sell a book or anything else. All we're trying to do is just try and give people quality education. And this is one of the few forums out there that somebody like me can go and just, we call it jazz. You can just go ahead and relax and teach something that you want to teach. So let's answer some questions. What software can do shift median lines? At this point, TJ, well, Cynthia won't be mad at me. At this point, IB's does not do modified shifts yet, but you don't have to answer this right now, Cynthia. No pressure. We'll just leave it alone. But there's a rumor that there's new and improved charting capabilities coming down the road as their platform is being reworked, which I believe it is. And I don't work for IB, so I don't know anything inside, but almost everybody has modified shift. Now, some of them call it modified, some of them call it 50%. It's all the same thing at this point. For example, Advanced Get, they can't swallow calling it modified shift. I don't know why Tom can't, but he calls it modified. Okay, fine. Somebody else calls it the 50% median line. It's a modified shift. I'm sorry. They should give credit to Jeremy Schiff, who invented the modified shift in 1972. I actually was at Dr. Andrews' house when he presented it. And, it's a very useful tool. Let's take a look. If you draw a regular channel with the middle line, you get the shift. Yes, kind of. But let me just say this to, I think it's Andre. I don't know if I have your name right. I don't read that well, and you know, it's hard to present. It's hard to get names from the other countries correctly. I have enough time with TIM. But anyway, channels. Let me just explain something to you. There's a set of lines that all derive back originally to action-reaction lines. Channels are a part of them, as are median lines. The problem with channels are you have to go so far down price action to get the channel before, and it has to be tested afterwards before you can actually rely on it. It's called curve fitting. With median lines, you don't have to do that, okay? So if you actually think that you can do the same thing with a regular channel, you need to study more. Modified shifts have a mathematical probability the moment you identify the A, the B, and the C. Channels do not, okay? We're not channel traders. I'm sorry. And you need to know the difference. There's a huge difference. I can identify with a modified shift long before you can identify and with a channel. Maybe I'll make that a presentation sometime, where support and resistance is. That's been tested, and that's why it's important. Can I also explain the T formation? No, you know, Oliver, it would take too long for me to do it here, but it will be in one of the presentations coming up, and it will be prominent. And that comes directly from my partner, but I will be glad to add it. Peter, you should know better. A channel is not the same as a modified shift in any way, shape, or form. Sorry. I wish I just don't have time for the Texas team. But take a look. You can do the homework and reproduce it. It's not that hard, guys. Yeah, if you go to medianline.com, there's over 100 articles there. Also on market geometry, if you have free information, the same articles get loaded to you right there, and lots of that stuff is there. When will my new book be out? I'm deferring that question to my wife, John. Didn't quite understand what you mean when you were talking about failures. How do you recognize a failure to take advantage of it? Okay, perfect example. Let's say you've just had a simple trend line, a horizontal trend line, and it's been tested 3 or 4 times. Price keeps bouncing over it. Well, if it finally breaks through, you're going to get a heck of a move, and the reason why is because so many people are now short against that line with stops above it, that the stops propel price higher as well as breakout buyers. Okay? How do I deal with the opposite median lines that can be drawn on a chart and avoid confusion? Well, Paul, one easy way is just use the major points. We like to say, you know, show me something interesting. Don't just draw off of any pivot. You can draw off of any pivot that has a mathematical probability. And in fact, one of the studies that I did early on was I took the S&P futures and I used I think I used 2,000 pivots publicly. Actually, if you look at in my first book, there's 37 pages, I believe, where I use every single pivot on a 5-minute chart in the S&P, and 87% of the time, price made it to the median line. How about that? And I just stopped because it was just so boring. So you can just use every pivot if you want, but if you use the major, and by major, start out with the major highs, the major lows, major highs, or vice versa. Remember, they also always have to be alternating. Or the reason we show these past 2 months sessions is because gaps and wide range bars, their extremes and or their opens and closes can be used as pivots if you need a different high or low. And in this case, you saw that I used that low of that gap as a major pivot because that was an extremely important event. Let me see if I can skip to that. So I'll pick that out of the air. Extremely important event. Here. I used this high. This was the highest high. There's no arguing there, and it was after an extremely important event. I used the lowest low. There's nothing to argue here. It's the lowest low in the chart. This is the highest high. There's nothing to argue. Once you use this high, and use this low, you have to use something to the right. What would you use? The highest high. That gave me everything I needed. This gap may be interested in getting short. I let it test. You can see price fails and falls down here. I want to sell the retest. Where can I put my stop? Right above the C. I can afford that. I might just put it above the poke, but that's a little cheap. In this case, it worked. But certainly above the C, there'd be sellers at the C point because it failed there. Also because if you run it over here, you'll see you're right back into the congestion. So I picked the major events. Very simple. That's where people get confused. They go, well, let me draw here, here, and here. Or let me draw here, here, and here. You can do that, and there are times to do that, but start out with the major events and get good at that. You'll still catch 90% of the trades if you just go there. That's all. In a trend line from A to B pivot, find the center of that line, then move your A pivot of the pitchfork to the center point of the... Oh, you're okay. You said yes. Okay, okay, Jay. Jay's answering a question. Tanyo, email me. I just commented Bradley or Oliver on my A pivot of the gap versus other choices. I mean, it's just that's the nature of this presentation. This is a different way. Wish I could do this faster, but I don't have them numbered. I'm sorry. Just 1 second. We're coming. There we go. This is a major gap. This is big news, boys and girls. This is, what do you want is an event that makes you sit up and go, wow, look at that. So you're snoozing away in your chair because you're either long and you got your profits going, or in which case when the gap's higher you're happy, or you're snoozing along, nothing's going on, and you swing over to the Euro FX currency futures and you go, whoa, look at that. That's a heck of a gap. Well, this is a major pivot. This is as major as this A. In fact, it might be more, because what does it show you? Not only were we in an uptrend, but these buyers didn't want to wait. They just jumped into the market. Come and get me. That's a big deal. This doesn't take 10 contracts. This takes tens of millions of dollars to do. This takes a lot of do-re-mi. Tens of billions of dollars to do. This takes a lot of do-re-mi. So this is a major event. That's why I chose it. That's what we're looking for. Greg says, isn't that a 88.6 or a 78.6 retrace? I got no time for that stuff. If you want to talk about that, that's fine. The problem with that is, Greg, even you don't know which one it is. It's, what is it? Is it a 61.8? Is it a 78.6? Is it an 88.6? The numbers go on and on and on. And now I have people that claim, I have a guy that's trying to patent the 88.6 retrace. Please, stop yourself. And another one that's got the 91.2. You know, enough, please. Georgie says, I have made a modified shift tool for MetaTrader 5 if anyone's interested. There you go. There's also one out there for 4, I know. I'm not trying to be mean. I'm just telling you, you know, if you want to use that, that's fine. That's not what we're here for today. Can I properly how to show and draw how to drive action-reaction line? Take a look at the work, the homework I gave you, and see if you can draw them. Maybe we'll do, if not this next one or the one after, we'll do a whole action-reaction series. Although I don't know what the, I'm trying to decide whether or not Barbara told me what the instrument is. I don't know what the instrument is. We'll find out. You'll know shortly. Yes, Georgie, if you send me the modified, shift tool for MetaTrader, I would definitely put it up somewhere on market geometry and make it open to everybody. Absolutely. We have any more? TradeStation modified shift is listed as a regular shift and vice versa. Yes, Mark, I helped them correct those tools in the sense that got the math right, but then they got the labeling wrong. And you know, I keep talking to Stan and trying to get him to get them reversed, and they're just overloaded. But they will. Just remember, if you hit regular shift, it's actually a modified. If you hit modified shift, it's a regular. But if you use it a couple times after a while, you get used to it. It's okay. Wayne says, what concerns me is the discretionary aspect of selecting the median, the anchor point, especially since it's being relied on for prediction. Well, Wayne, every trader in the world wants everything to be black and white. So you have to decide for yourself, sir. And if you don't like it, that's okay. No, you don't have to say boo-hoo. It's okay. He's got a valid point. I'd like to say it's 80% science and 20% art. Okay? And I got 3 PhDs. So I know the statistics. But that being said, here's what I get. Everybody wants, if we talk about the Texas T formation, or we talk about gaps, or we talk about median lines, no matter what we want, everybody wants black and white. But the world's not like that. Trading isn't like that. You're going to have to make decisions. And median lines, you say you don't like them because of the discretionary aspect. Well, I'd say to you, show me another leading indicator. There isn't one. There's only one. So to get something, you have to give up something else. Is there some discretion involved? Yes. Do you have to use the gap? No, you don't have to. You could have gone all the way back down. Yes, you could have gone all the way back down to this A and drawn this and tried the modified shift. It might or might not have given you a trade. I don't have the ability to draw in here, but that means if you want to just go low to high to low and use just the major stuff, as I said, 90% of the time you'll catch the trades. You'll catch plenty of trades. You just need to be a little bit more patient. Then there'll be no discretion. I will tell you this, Goldman Sachs in the 1980s, actually Citibank, excuse me, in the 1980s, spent $25 million trying, and I was one of the people that was in the study. There were 5 of us that studied under Dr. Andrews. They tried to make this a system that take the discretion out. They spent $10 million building the system, and they threw the box out the window after they lost $25 million. Then, recently, Goldman Sachs spent over $50 million trying to do the same, duplicate the same study. And yes, I was one of the participants. After they lost a quarter, $250 million, they threw that box out the window. Okay? It's not programmable. There is art in it. I'm sorry, that's the way it is. But if you are a systems trader, I happen to be a very close friend of Richard Dennis, probably one of the best system traders in the world. Certainly the earliest well-known system trader. He's the guy that came up with the turtles. His systems change all the time. He's not trading the system that he was trading in 1984 or 1994 or 2004. It doesn't work. Sorry. So that's what you get. Let's see. Practice reduces discretionary bit from the beginning near 100% to around 10%, so just practice it, Bradley. Okay. Have you ever used any other indicators in your charts, Tim, to help you read price apart from median lines and market structure? I know them all, Keith. I know every indicator there is. I have a PhD in math, and I study them all. And, the older I am, the more I study, the less that's on my chart. And there's a famous, to some of you at least, there's a famous website called Trading Naked Traders, NQs. I'm the first naked trader, and they don't mean without clothes. They mean there's never any squiggly lines on my charts. I'm number one, and the reason why is because I just don't do it anymore. Now, when I mentor people, if you come in and you're being mentored for 12 sessions, and you use, for example, Market Profile, and I was the funder behind Market Profile early on when I was at Bank World. I'll work with you and teach you how to use Market Profile and teach you how to use it correctly, and then I'll teach you how to use Market Profile with median lines. One of my closest friends, who's made several $1 billion trading his own account, uses point and figure with median lines. So, you can combine it with anything if you use it correctly. I would say the most important thing is market structure, understanding the flow. You better have if you want to make consistently profitable trades, you better understand money management and risk reward. You better get a good feel of those things. And me, I like to use lines. Don't see a shift pitch work on TradeStation under drawing. Somebody will type it in for you. It's easy to find. I still have TradeStation 4 on my machine, so don't laugh. Georgie says, could I dedicate a session to Andrew's methods of 0-4 lines? George, I might mention it, but it's not worth a whole session. Mark Zucker says, if you want TradeStation, go to the education area. It's all over there. There you go. Can you slowly and carefully point out all the correct steps to save the charts? putting this in writing would be best. Thank you. No, Ken, here, listen. When you leave, a box will pop up, and it'll say, do you want to download the chat? Do you want to download the charts? Do you want to et cetera, et cetera? You get the, and all you have to do is say yes, and it'll just download onto your computer. It's dead, I like to say dead dog simple. You can't mess it up. Don't worry about it. And that will save the charts for you, and then you can print them or not. It's up to you. I think we're running low. I'm not trying to be cranky, by the way. Yep, I'll see you, BJ. Thanks for coming. I'm just trying to answer questions, honestly. One thing I always appreciate is if we stay, when we ask questions and during the presentation, stay on target with, if you're there with a guy that's doing fibs, talk about fibs. If you're there with a guy that's doing market profile, talk about market profile. Don't bring up my name. Just stay there. How about that? You know what? I'm always, somebody said I'm a good teacher. I am honored to, look, I spend time teaching 12,000 fifth graders. I wouldn't do that if I didn't think it was important. I spend my time at MIT and Stanford and the University of Chicago free. Why would I do that? Because I enjoy teaching. I learn from teaching. So I love doing this, and Cynthia gives me a great opportunity to do it. Cynthia and the CME, that's who I work with. That's it. So I'm honored. Thank you all. Can you join the fifth graders class? It's not. I don't run it. See, you have to understand. There's like a what do they say? A Chinese wall. Would you want your fifth grader to actually be in contact with somebody that you didn't know if you were a parent? I have a sixth grader and a seventh grader. Okay, and I wouldn't want them to be involved with somebody that I didn't personally know. I know all their teachers. So there's a Chinese wall. The schools sign up through an association. It goes through. Everything runs that way. Okay, we're going to put out a charity book later this year called Crayon Drawing. It's going to be very short, probably 55, 60 pages, which will just show you what we teach the fifth graders. And I'll tell you what, last year they out-earned their rate of return, if you annualized it, was better than the #1 hedge fund trader, a public hedge fund trader. So it's fascinating to watch them trade. Let me just say, they pull some trades out where I just shake my head and say, I never would have seen that. How about that? It'll be a book, and we're going to do a book, and we'll also make it Kindle. How about that? And we'll let you know on the website when it's out. It's not out yet, but it's coming. We're just trying to get it to work and look nice on Kindle, because a lot of people, Kindles, and then we're going to give all the money to charity. So, Cynthia, I think we're running low, and I know you have a timeline.
Well, actually, and you're coming in underneath that, Tim. You are excellent. So, and I have to thank you very much for the time that you're spending with us today. And just remind everyone to mark your calendars, March 8th. We'll be doing this again, so we'll taking additional information. So,
It's March already? March is coming up already? Oh, my God.
Oh, the year is flying by. Now, I also want to mention we are recording today's event, and everyone who's registered will get a direct link to that playback later on this afternoon. So if you're interested in coming back and reviewing those concepts, simply watch your email for a direct link to that playback. But it looks like, and Vittorio is asking, where can we see videos of past sessions? Well, Vittorio, if you go to interactivebrokers.com and click through on our, there's an individuals page or an institutional page. Now, each of those includes an education menu. Simply go to the educations, click through, and you'll find webinars, and once you get into the webinars, there's a selection whether to sign up for upcoming events or to listen to pre-recorded events. Now, we do have quite a few recordings out there, so do check the industry-sponsored tab, and you'll also be able to filter with the boxes that are included at the top, either filter by speaker or by sponsoring exchange, and you can easily locate all of Tim's previous recordings with us. They're posted out there as well. So with that, looks like we are going to conclude today's event, at least for now, but we'll be back with you in just a few weeks, so be watching. So thanks, everyone. Thank you, Tim, very much for the time that you've spent. And I also want to thank the CME once again, because Tim's dedication to education, as well as working along with the CME, has brought today's presentation to you. So thanks, everyone. Have a great afternoon, everyone, and do trade smart. Thanks, Tim. Can't wait for next month.
Thanks, Cynthia, and thank you, David and Barbara, wherever you are. Big hug and kisses to Barbara at the CME, who makes all this happen.
Excellent. Well, have a great day, everyone. By the way, you can, as you exit, do be aware of that PDF that will pop up. So if you do want a copy of the slides, it's included there. It will also be listed on our webinars page next to the recording link so that you can actually download the notes from there. So thanks, everyone, and definitely thank you very much, Tim. Have a great month. We'll see you soon.
Take care, all.